Valutrades, forex CFDs and commodities.
Those 4 M's of trading. Markets, you want to know what your market is. You want to know what it is you're actually looking to trade. You're looking at the method in terms of what's your tactic, how do you actually execute your particular trading method, and that's what we'll be talking about this evening with regards to inside bars. It's important to know the money side in terms of your capital management and your risk management and your trade management. And then finally is about managing myself, which is about really understanding and managing the implications on your physical inputs as you trade markets. So what I tend to find over the years is that when all of those 4 M's are in good alignment and in good working order, that's when we tend to trade at our best. Alternatively, if you're having a few challenges, well, give yourself a quick review of those particular 4 M's of trading and find out, where you may be struggling, because I can assure you that's probably where, you need to do a little bit of work to bring yourself up to speed. So, in terms of the ideas that I look to share with yourself, throughout the trading, is that I like to share very simple ideas that are both time frame and instrument agnostic. And what do I mean by that? I want to show you very simple setups that could work across all time frames on all instruments. Maybe you're a trader, or perhaps you're a weekly trader on gold. All right, what I want you to do is to have some tactics, having some insight into whatever you trade, however you trade, you're able to use it. My own particular trading is, I personally love the weekly charts, and you'll see quite a few examples of that later on in the slides. I think the weekly charts are fantastic, trading time frame, especially if you're an individual who trades around a day job, because really late, and then just perhaps 10 or 15 minutes during the week to just keep on top and just check in with your trades. And so it means that you're able to effectively operate around, let's say, a day job, if you're a part-time trader, without it requiring that constant connection to the markets. Furthermore, there will be, I know, every year across all of the instruments that I trade, I know that there will be somewhere between 2 and 6 trends, during that year across the sort of multitude of instruments I watch. I don't know where they'll come. I don't know when they come, but I do know that they will happen. And as someone who trades the weekly chart, when one of those big, let's call it like a super trend occurs, well, then I want to be in a position to ride that for as long as possible. And hopefully you'll see tonight how the inside bar can actually give you a little bit of help with that, can actually provide you with a little simple opportunity. So with regards to that, the inside bar is sometimes called the harami, which is the Japanese term. If you've read any of the sort of Steve Neeson books about Japanese candlesticks, you'll hear some traders call it the harami. But normally you'll hear, let's say, traders in the West calling it the inside bar. And as we go on to the next slide or two, you'll realize very, very quickly why that is so. So, where is that inside bar? What is it? Well, at its most simplest form, the high and the low of the bar is fully within the range of the preceding bar. Okay, the high and low of the bar is fully within the range of the preceding bar. That's what we're looking there. I'll just see if we can draw using this fantastic technology. We can see this is our inside bar here. All right, just there you go. Forgive my artistry. I'm a better trader than an artist, but let's just work with this in terms of, we can see here there's the low of the bar before and the low of the bar after, and this bar here, the high and the low of that bar is fully within the range of the preceding bar. And how I like to describe this to traders, to new traders, is I want you to think of it like an organism and how it breathes. Just think about how you breathe yourself, all right? Just think about it, you know, we breathe in, we breathe out. We breathe in, we breathe out. And markets are very much like that, you know, and I want you to sort of, instead of thinking as a market as something that is confrontational, that you have to wage war against, think of it in terms of either, you know, like an organism breathing, or perhaps as the ocean, the currents of the ocean, the sort of tides come in, tides go out. And that's the way to think of it in terms of an inside bar. I like to think of it as what happens is we have a surge, then we have a rest, then we have a surge again. And that's how humans operate. You know, when you're doing anything with any intensity, you know, we will have a surge, then we need to rest, and then we surge again. And that is what the inside bar is like in terms of trading and financial markets. So, you know, what we have is the inside bar. If I just draw that, the inside bar is the rest. And what we're looking to do, we're looking to catch the next surge. Think about that. So, you know, markets here, it's had a surge down, pulls back here. This is the rest. The final part of the rest is the inside bar here. There we go. And then the market surges again. So just think about that. Surge, rest, surge. That's what we're looking at. Surge, rest, surge. And, you know, it's a good way to think about when you're identifying these inside bars and whether they are a suitable trading opportunity to think, you know, has the market surged before it's taken a rest? Because sometimes the inside bar will show up, you know, in certain places. But if you can see very clearly, like in this example here, where the market has surged, then rest, then surge again, that gives you a good idea that, you know, how valid the opportunity is. Okay, let's see if we can get a super. That's working. Okay, so here's some examples for you of an inside bar. Now, this will hopefully give you an idea. If you're completely new to trading and just trying to understand this, well, you know, my suggestion is, you know, take a screenshot of this, take a print of it, okay, take a photo of it, stick it up on your wall, all right, in front of your trading desk, so you have it surrounding you. There's no escape, and that allows you to almost like osmosis, just have these examples sort of sear themselves into your brain. So we can see we've got three correct examples and one that is incorrect. Now, hopefully you can very, very clearly see, okay, how the range of this bar is inside the range of the one before. Same here, okay, it's the range, the high and the low of that bar is inside the bar before. Sometimes the big bar is called the mother bar, okay, some people will call it the mother bar, okay, and they talk about this, you know, the inside bar being like, you know, like almost like you know, like a woman with a pregnant child, or like a kangaroo, okay, with the carrying the sort of the small baby kangaroo in its pouch. But, you know, it's, you know, you'll hear some traders talk about it as a mother bar, but the important thing is, all right, all that matters is that the high and the low, okay, of the bar is within the range, okay, within the range of the preceding bar. That's the important thing. That's the important thing. And we can see in this final example here, ladies and gentlemen, that actually what you can see, hopefully, there is that it isn't an inside bar, because actually the range of the bar, the high of that bar, is outside of the range of the mother bar. Hopefully you can see that there, although my drawing doesn't particularly help. Okay, so there we go. You know, you can see that that's what's happened there. That is not an inside bar, because the range of the bar, okay, the high and the low, are not within the range of the bar before. Okay, so just always make that very, very simple. You know, once you spend a little bit of time, just basically working through and checking, just looking on charts, trying to identify, you'll find it very, very quick and very easy to identify those inside bars. So now that we've discussed what is an inside bar, now that we have understood, some examples, so we can actually very clearly see what is the inside bar. Well, now let's talk about, well, how do we trade it? How do we actually trade the inside bar? What is it that we need to do to be able to make it work for us? So what we have here is, I tend to use them as two ways to trade them. Okay, first one, as part of a pullback in an existing trend, or two, as part of the breakout into a new trend. You might have heard me talk about, sort of different types of trading styles in the past, and I always talk about that you can boil it down to a trading method that is either a pullback, okay, or, as a pullback or a breakout. We're looking for, a breakout of a line of support resistance, or a pullback, or a bounce, which is a bounce off level of support or resistance. So if I just look at this particular example we have here, all right, this one, this inside bar here under the arrow is as part of a pullback in an existing trend. There we go. Let's just see that. Hopefully you can already see that yourself. Okay. This is, we were in a downtrend, price has been moving down, it then pulled back, right? It surge, rest, surge again, and that's what we're looking to actually to take our trading opportunity from. So you can trade it as either part of a pullback in an existing trend or as part of the breakout into a new trend. So what we have here is, just an example. This is, I think, just a chart I just took off from the from any particular instrument. It doesn't really matter, and that's what I suggest to people is, just to do that, to effectively just to bring up a chart of anything, any chart, any time frame, and then go through and talk about, find where the inside bars are. Here we have this candle here is an inside bar. But then actually what happens is, we have a sort of a small breakout, okay, a little bit of a teaser there before actually the price continues in its downtrend. Price then pulls back, and what happens is, it finishes with an inside bar at the end of the pullback. Price then goes down, and then price basically goes sideways. Price goes sideways. So we have an inside bar here, okay, but actually, as I was saying earlier, thinking about it surging, rest and surging, okay, when you're going a little bit sideways like that, where you have one here, okay, you have another one here, that's where I tend to particularly tend to leave them alone. All right, I'm going to leave them alone when price is in a consolidation. But what I do like to see, let me just clear this, is when price breaks out of that level. Remember, price breaks out of that kind of level of support. What happens then is we have an inside bar here. All right, price creates an inside bar there, and then what do you know? Price continues down, and that's what we're looking at. And then we can see that price reverses. Price reverses here. We have a low here. We then get a higher low. Then we're starting to get higher highs on the top of the candles. Just remove some of this, and then price shoots up. And as it sort of breaks to new highs, we get effectively another inside bar here, okay? As price is moving up here, we can see that this real, big candle has kind of broken us away. It's a real strong breakout, and it's a case of, this is the surge bar, all right? This is the surge, then this is the rest, and now we're looking forward to see, it surge again. Surge, rest, surge. That's what we're always looking for. That's what we're always interested in. So I had a question from Tony there. So do you find inside bars more prevalent to particular types of instrument? That's very good. That's an excellent question, Tony. Thank you. I particularly like them on FX pairs and also on some of the indices on higher time frames. As I said, you can use these across all time frames, all right? But for my own personal trading, as I said, I'm looking at these on normally weekly is the first place where I'll start to look at, and I found that on FX pairs, especially when they're in a nice trend, or indices when they're moving nicely, when you have a little pullback that ends with an inside bar, that is a good opportunity to get on board. Or if there's a breakout to new levels and the inside bar is there, then effectively you can that provides you an opportunity to sort of get on board that trend. As I was saying earlier, one of the reasons I like that weekly candle is because I can actually look at the weekend. It doesn't take very long for me to to sort of go through the chart, identify it, and take it from there. So sorry I didn't hopefully that gives you a little bit of insight, Tony. And what I'm actually going to do is I'm going to show you some examples as we go through the rest of the session. Show you a few examples from both FX and indices, and give you a little idea of what I'm actually particularly looking for. So let's have a little bit of a look in further depth. What we talked about is there's two ways to trade these inside bars. First one is as a pullback in a trend. So on longer time frames, you can use the moving averages to define the pullbacks. If you're new to trading, if you're new to trading and sort of still maybe struggling to fully identify the actual trends, well, I would say that put a lot of work and practice into doing that. The quicker you get at identifying the market environment, the better your opportunities will be. But if you're looking on longer time frames, sometimes moving averages can be used to define pullbacks. As in, price will sometimes pull back to a level of what we would call dynamic support resistance. Why do I call a moving average dynamic support resistance? It's simply because it's dynamic because it's constantly changing. Those moving averages are changing every, well, whatever time frame, between every hour, every 4 hours, every day, every week, every month, depending upon the time frame you're trading. They're dynamic because they're constantly changing. Whereas you'll hear me talk about static levels of support and resistance, and that's normally things like a big round psychological number. So today on the Dow we had 23,000. All right, so that's a big round psychological number. But also you'll go back and be able to draw in longer term levels of support and resistance based just upon your simple chart analysis. But when you're looking to trade them in pullbacks, sometimes that dynamic support and resistance, okay, offers an opportunity where you see price pull back towards it, and then when we finish our little rest with an inside bar, that is something that gives us the opportunity to sort of trade and take a trade or take an opportunity to join the existing trend. So I've put there long terms for things like weekly and daily setups. As I said, they set up across all the time frames. You might want to use the 4-hour chart to execute and manage that position. I would probably suggest that's a little bit more of an advanced sort of way of managing your trade. As you become more experienced, you'll be able to sort of read, let's say, the flow of the market. You'll be able to understand, whether the tide's coming in or coming out. And so you'll be able to sort of utilize that increased experience and skills to be able to work with that. Great. No, I'm happy to help, Tony. I'm glad that helped you. And yeah, Robert, sorry I didn't see that. Yeah, very, very welcome. Nice to have you join us from Austria. So that's great. Hope you're enjoying yourself. So yes, so to begin with, I suggest just look for inside bars on the time frame you presently trade. Maybe you're a 15-minute trader, maybe you're a daily trader. It's, as I said, these are set up across all time frames and all instruments. But if you are a more experienced trader, then you're particularly looking at weekly and daily setups, and then using the 4 hours to execute and manage is a little bit more of an advanced version. And I do appreciate that some people may not have the opportunity to check their charts every 4 hours if they're traveling or in a particular day job. No, that's absolutely fine. That's that's absolutely fine. There's you have to trade what you see in line with your own trading lifestyle. So what you can do is decide the entry on whether it be the break of the bar or the break of the range based upon the size. So what does that actually mean? Well, hopefully you can see in this particular example here. All right, we have the inside bar, but actually we can see that even though the high and the low is is well within the actual range of the bar, what we can also see is that the kind of high and the low of the preceding bar are very close as well. So when they're very, very close like that, what I look to do is actually I'm very happy to sort of to sort of have my entry on the break of the mother bar, right? That's what that's what I'd be looking to do when they are very close. If it's very wide apart, well then that makes a different that's a different scenario, and then you're looking at the actual sort of size and scale of the particular inside bar, and it may well be that the break of the actual inside bar, right? In this case, the break of the low of that, that might provide in itself a good trade opportunity. But as a general rule, if the inside bar is not too much smaller than the let's call it the mother bar, well then it may well be that you decide to trade on the break of that mother bar, right? So it's there's a little bit of experience, but it's not very it's very simple to see that. You'll see that on a chart and recognize that very, very quickly, all right? Whether it's which way you particularly wish to operate. So, not surprisingly, if you're looking for inside bars in a pullback, well, they work the best in trending markets. Not surprising that, really. Okay, what we like to do is to have a good trending market where we can see that pullback. That might happen on the 15-minute chart. It might happen on the weekly chart. It depends upon your own particular style of trading. And what I do is I consider that as a continuation signal. Normally, you're looking at one of two sort of very simple versions of a signal. You're either continuation, i.e., you expect the existing trend to continue, or you might hear of a reversal signal, and not surprisingly, that's because we expect the market to reverse. And when it's forming at those support and resistance level, it can act as a stalling, as a stopping signal. Okay, that goes back to almost like the first sort of slide I put up. It's surge, rest, surge. So market surged, it's having its rest as it pulls back, and then it's getting ready to surge again. And where that that inside bar can appear as kind of it's like the stalling. It's the sort of the rest is over, the pullback is over, and now the dominant trend is getting ready to re-exert itself, and that is actually what we're looking to be a part of. We'll just see another question here. Okay, are inside bars more common in a downtrend? That's a good question. A good question to Tony. I wouldn't necessarily say that. I personally haven't found that with my own experience. What you might see is you might see a few more bearish examples in my slides, but that's because I have a bearish bias myself. So 2/3 of my trades are to the downside. And I know that about myself. And that's a bigger question for one of the webinars in the future about understanding your own particular trading style. I personally, I'm a bear in terms of I like to short markets. But however, what I would say is that it's I personally haven't found them more common in a downtrend. You'll find them equally valid and equally available in both uptrends and downtrends. Okay, so we talked there about the first one about the trader's edge being trading as part of a pullback. Okay, pullback in an existing trend. Well, now let's have a look at the other side, which was to trade it as part of a breakout. Okay, not surprisingly, as the name implies, what we're doing is we're looking to take a position when a particular instrument breaks out into a new trend. So not really rocket science, not really nothing really revolutionary there, but that's actually because what we want is very simple ideas that we can identify very quickly. We can have a very clear and precise point at where we know we're entering a market, where we know we're getting out if we're wrong, and where we're getting out if we should know that we're that we're right on the right side of the trade. So here I put there on the longer term time frames, you can use support and resistance to find breakouts. Yes, I suppose that links to my own personal experience, but realistically across any time frame, and even if you are a short-term intraday trader, you still want to understand what are those support and resistance levels for that particular session. Maybe it's let's say static ones in the sense that ones that you draw yourself just based on chart analysis. Or on intraday, it may well be something like you're using pivots, okay, and that might look or act. Price may treat that as an intraday level of support and resistance. once again, you know, if you're looking at these on the weekly and daily chart, if you have the opportunity, then, you know, you may use the 4-hour charts to execute and manage them. That is just a, you know, that's, let's just say, a little, as I said, a little bit more of an advanced way to do it, but don't feel that you have to. Don't feel that that's, you know, if you are looking at them on the weekly and the daily charts and you can only check in on your charts, you know, once a day or, you know, a couple of times a week, that is absolutely fine. That is absolutely fine. And actually, in some respects, for new traders, that's actually sometimes even better, because what tends to happen is the more you look at your positions, the more your impulse to interfere in your positions rises. Okay, your ego will start playing games with you. Your ego will start telling you that you know best, that, you know, whatever the market's doing, that you know best, and it will play tricks on your mind. It'll make you want to interfere with your trades, and most times, okay, most times over the long run, over a larger sample of trades, what you'll realize is that, you know, you're best just leaving the trade alone. Okay, plan the trade, trade the plan, manage the risk, let it play out. That's your job. Once again, you know, you decide on the entry or the break of the bar or on the break of the range based upon the size. So, you know, what we have here is that, you know, this is a chart here, and it's, you know, I haven't got the rest of it here, but what we had is that, you know, price was going sideways. You can see, you know, you can see yourself, this was 1, 2, 3, 4, 5, 6. So, you know, we were going sideways for, I'm sure if this is one of mine, I'm sure this is a weekly chart, because I love them. So, you know, this price is literally going sideways for 6 weeks in a small range. Then what happens is, you know, in this week we have, you know, a very big breakout. You can say that it's very strong, isn't it? Very strong breakout. Okay, you're left in no uncertain terms that, you know, this is a strong breakout. You know, the buyers are in charge of that particular market. And then what happens the next week? Well, next week we have a inside bar. All right, you can see that there yourself. You know, the high and the low of it, okay, are within the range of that preceding bar. So what we have, you know, what were the 3 words I used to describe, okay, inside bars? All right, we have a surge, then we have a rest, and now we're getting ready for the next surge. And as you can see, you know, because the high of the inside bar was very close to the high of the bar preceding, what you'd be looking to do there is, you know, to have an order to buy the break of that particular high with your stop beneath the low. And, well, you know, in this particular case, as you can see, the, you know, the price actually fired off and launched itself north. Okay, and this is, you know, what I was saying, you know, is that, you know, on weekly charts, something like this, is that, you know, when a new big dominant trend re-exerts itself, there is the opportunity for it to run, and this is just a very simple price action way that's very easy to identify in terms of, you know, using that as a way and a means to join the party. So, you know, in terms of breakouts, well, you know, what we're looking to do is, you know, wait to see price breakout of a zone itself, or the you know, or the opposite trend. Okay, so if you've been in a downtrend, then you might see price base and roll over. It might reverse, but ideally, what we like to do is to see, you know, trends like that where price has been consolidating, going sideways for a little bit, and then, you know, it's a very clear breakout. Okay, you can see that's very clear. You're left in no uncertain terms about what's going on. You're left in no uncertain terms, you know, who's in control of that market. All right, you can see that, you know, in that particular example, buyers are in control of the market. So I want an opportunity to be a buyer. That might sound utterly simplistic, but, you know, even Jesse Livermore, you know, talked about that. You know, when markets are going up, you want to be a buyer. When markets are going down, you want to be a seller. That's, you know, so generally a pretty good way to sort of to trade markets. So, you know, as I said, price will often pause after that breakout. Price will pause. It'll take that rest. Okay, this is your setup. Wait to see if an inside bar or army sets up, and then you're looking to trade in the direction of the trend. So, you know, as I said, this, you know, on a weekly chart, you know, a little bit of time at a weekend, you can identify that and find out your levels. Monday morning trade, or Sunday night or Monday morning, depending upon where you are in the world. You know, you can basically fire up your laptop, put your trade in. You know very clearly where you're getting in, and you know very clearly where you're getting out. If you're wrong, you know exactly where your stop loss will be. And then, you know, based upon, you know, your target part of it will be based upon your own risk profile. Some people will have a nice target that they'll want to hit. Some people will have a nice trailing idea that they want to hit. So, what you'll find is that myself and my other colleagues here at Valutrades, we can teach you all sorts about trading. We can teach you about trading until the cows come home. But the one thing you have to know and understand yourself is your risk profile. That's the one thing we can't teach you. Understanding your own risk profile. Some people are very aggressive. Some people are very happy with risk. Other people are very averse to risk. They're very conservative. There is no right or wrong, okay? There is no right or wrong. What is important is that you trade in line with your own risk personality, and that, I think, is absolutely key. So what we have here is that we just look at the next opportunity. I said I'd show you a few examples here that we could talk about. So this is actually a monthly chart, just one that I just plucked up and wanted to show to you. And what we have here is we can see that there's quite a few examples. So this is the monthly chart. I wouldn't expect many particular traders to be trading the monthly chart, all right? But I want to show there's all sorts of different examples of where opportunity arises, and hopefully you can see there's a few examples where the particular particular trade didn't really particularly work out. Nothing ever works. Nothing ever really particularly lasts forever in that sense. So what we're looking for is when we find a winning trade, we're looking to basically to stay with it, to effectively to trade in that particular direction. So you can see that as price pushes up, okay, you can see we had an inside bar here, okay, but realistically what we're looking for really is actually ideally in that particular case you're looking at as price has been coming down, it's gone up, its price come down, it's gone up, it falls down, all right, again, but actually what you have is then you have an inside bar at the end of it, okay, you have an inside bar at the end of it, and then actually price sort of starts to break out. Price starts to break out, you can see price breaks out these levels, and then actually what happens is we have another inside bar here. Now of course this is the monthly chart, all right, this is the monthly chart. So here's a good example of the high of our candle is there, but the high of the mother candle is there. So I mean that doesn't look very big on a chart, but remember, ladies and gentlemen, this is a monthly chart. This could be a couple of 100 points, okay, the difference there. So in that particular case, you want to use an element of common sense and look to trade a breakout of the particular high of it. So we can see price moves up again, price comes back, okay, price breaks through again and eventually goes up. What we see is price breaks this recent high here. Then what does it do is it puts in another inside bar here, and then basically price moves up nicely. What we have here is that this is an example here, but what personally as I was saying, even though price does go up, personally what I like to see is either very clear breakouts, okay, or very clear pullbacks, and for me, all right, that's not really prices had a bit of a surge, it's now going sideways, all right, and yet yes, price does go up eventually, but for me it's not a particularly personally very clear example, okay. I like to keep it simple and keep it clear. So Tony's asking, curious to know what are the two moving averages used there. Yeah, no, I'm very happy to share that with you. Just let's get rid of it, make it clear. Desperately simple. So the blue is the 20 period moving average, and the red is a 50 period moving average. All right, very simple. Nothing. They're pretty standard. 20, 50, and 200. Okay, moving averages. Very what's the word? Very simple. Very just very standard. I run traders events in London, and what happens is I get lots of traders coming to, and you'll find traders will argue. One guy will be saying the 55 period exponential moving average is better than the 50 period simple moving average, and another guy will be saying the 60 period weighted moving average is much better. The realistic element is that you could spend the rest of your life trying to curve fit moving averages. you know, I don't use moving averages for basically for crossover systems, which is what you'll find a lot of people do, mainly because, you know, they only work great in trending markets. When you're in sideways markets, you get chopped about. Actually, all I'm just using for is a simple indication of the trend, simple indication of maybe the sort of strength of that trend, and then also, as I said a little bit earlier, about using it as examples of dynamic and static levels of support and resistance. Hope that answers your question there, Tony. I hope that's yeah, I hope that helps you with that. Okay, so that was pound against dollar on the monthly. This is what I've got is Aussie dollar. Okay, on the monthly as well. So hopefully what you can see is that, you know, prices here starts off a little bit of a sideways. All right, there is, you know, there's actually a few inside bars here. Okay, but as I said, I personally don't really like to trade them, you know, within a range. Okay, some people may differ on that. That's you know, that's perfectly fine. But I like to see here, you know, what we had. Okay, is, you know, we did have a breakout there, nice breakout. Price moves up, but then, you know, there's no inside bar there until price pulls back. Price pulls back, and you can see, you know, it hits that you know, dynamic support. Okay, there's a nice bullish pin bar there, and then what we have is, you know, the next week is we have, you know, a nice monthly. Well, it's not next week. Next month there's a very small inside bar, and what do you know? You know, we break that the next month. Okay, or stop beneath, and well, you know, you can see yourself that actually, you know, in this particular case, using either targeting the recent high or having a particular trailing, you know, stop, even like you know, something as simple as a 2-bar trailing stop, you know, would have, you know, kept you for a good part of that particular trade. Price goes up, as you can see. We don't get any more inside bars until price returns down here. Okay, and then what happens is, you know, we have you know, this is interesting price action because we have, you know, lots of wicks to the downside and then lots of wicks to the upside, which is normally a good example of, you know, there's orders being cleared out. There's lots of for whatever reason, that, you know, that kind of level around, well, it's actually, you know, a big round psychological number of about 70 to 71. There was clearly a lot of action going on there, clearly a lot of orders going on there. And then we have a little inside bar there, which would normally, you know, most people would be waiting to see how that goes, but, you know, we're expecting, you know, we've had a surge, now we have the rest, and then what we're looking is, you know, we're still in an uptrend, so, you know, we're expecting to see a surge to the north of it. Okay, and then that's, you know, that's what it runs up. What we have then is, you know, we have here, you know, we've got a couple of inside parts there, right, and, you know, we've kind of broken to, we've got up to like double top levels there, so we've not exactly had a breakout. All right, we've not exactly had a breakout. Price actually gone sideways, but you know, and if you had tried to trade that into new one, well, you know, what you'd have found is you'd have probably been sort of taken out here for probably about a half hour loss on that particular case. So yeah, so he said there's, you know, there's a couple examples there, and you know, as I said, once again, it's about understanding whether you like to trade with a target, whether you like to trade with a trailing stop or trailing profit stop. And that's, you know, both are valid. It's about understanding your own personal risk profile. So here's an interesting one on this. Is you know, those were FX pairs, but what I've got here is the weekly Nikkei here. Okay, so this is for this year. This is, you know, very recent actually. So you know, price has been in an uptrend, right, and also, you know, the moving averages are very nicely moving. So what we have is, you know, price gets up to this particular level, and yes, it does put in a it does put in a little bit of a, you know, it does put in an inside bar there that pops up, okay, and runs. Remember, this is the weekly, so it's, you know, it's a move from effectively, what's that, about 19,800 to 2300. Okay, so there's still kind of 500 points there. But then, you know, what you can see is, you know, there are actually there's actually, you know, a couple of little inside bars here, but once again, remember what I was saying is that, like, you know, we're in a bit of a congestion zone there. We're in a bit of a congestion zone, and then what we finally see is that, just clear some of this down. We finally see is, you know, we know we're in an uptrend. It's gone sideways, and then we actually have a bit of a pullback. So interestingly, you know, this candle almost sets up as an inside bar, almost, but it doesn't. All right, because it touches lower. But then what we do have is, we have this candle here as an inside bar. So, price has gone up, it's gone sideways, falling back. We've had it as an inside bar. We can also see that it's, it's quite away from the high of the mother bar beforehand. Remember, this is, on a 5 minute. If this was a 5 minute chart, you might only be a couple of pips of difference, but on a weekly chart, that is, I suspect, probably around about 100 odd points, which is quite a chunky element trade risk. So you're looking to basically trade the break of that, and then with your stop beneath, and you can see yourself. What actually happens is that these are the kind of let's say the yearly highs here. Price breaks through it, all right, pushes up, and then what do we have? Well, we have effectively another an inside bar there on the breakout. So we've had a good one in in a pullback in an uptrend, and then we also have a one that is there we go. As price breaks to new highs, we get it there as a breakout, and then as you can see, for the last couple of weeks, the Nikkei has been moving nicely up, and hopefully you can see that very it's worked particularly nicely. What we have here, euro dollar here. Okay, this is once again from this year. Is hopefully you saw that we had 113 was a particularly strong level of resistance. If the chart had went back, you'd see it actually touches here a few times, and then basically we can see price puts in a couple of little inside bars, but it's price going sideways. Then we get the breakout, the surge. And then we have, here we go, we have this candle here, okay, which is an inside bar, and then price breaks and runs again, okay, and you can see that, it's that and breakout, that surge, the rest, and then it's flying north again there. So hopefully you can see that, and it raced all the way up. This is the, I said, 2050 and the 200, that is the 200 period moving average, is a very, what's the word? It's like a magnet in terms of, it's a very suitable target for your trades. Okay, in that particular case, you're looking at probably getting in about 114.50, running it up to about 117.50. So there was a good 300. There was a good 300 pip move north there on the weekly chart. So that was there for you to take part of. It's an interesting one. This is the FTSE 100. Okay, so we've been in an uptrend. All right, the averages are in alignment. Prices, it's not as flying up as much as the euro dollar was, but it's chugging its way. Okay, it is just chugging its way, grinding its way up there. Okay, and we have a couple of inside bars on the way there. Okay. We're looking at 73.70 up to 74.50. So on a weekly chart, that is still like an 80 point. There's an 80 point particularly move there. This one is this one would, even though it's pullback, it would fail. All right, but then what happens is price falls back near, and sometimes that's what happens. Sometimes what needs to happen is in an uptrend, price needs to actually fall back properly. It needs to have a proper correction. And then what we do is we actually have an interesting phenomenon where we have two. Okay, what we actually have is first inside bar doesn't fire, but then there's a second one. So there's this is a kind of a stronger pattern, and then what do you know, price breaks and actually goes to new highs up to the 7600 level. All right, price then pulls back, and then what it does is it sets up another inside bar here, and then that triggers, and with your stop wouldn't have been triggered for a while, but you can see yourself that it's working its way up there. Okay, it's hard work. Price pulls back again, and then what happens is the pullback ends with an inside bar. So here's another good example. Here's another good example. So you can very clearly see the inside bar is there. All right. If you were to wait for it to break out of the mother bar, you could see that you'd need to wait for the price to break there, which is it's just too far away. I can probably work that out. 73, 74. So it's probably about 120 points away. Okay. So to wait for that would be too long, but certainly the break of there, okay, is an opportunity to buy. And you know where you're going to go when you're wrong, when you've got your stop beneath it, and then that's what we've seen in the last few weeks. Okay, and interestingly, if you may or may notice, we've not finished the week, but that at the moment that is looking like an inside bar there as well. Okay, as price pushes up to these recent highs, so there'll be something there for us to keep an eye on. So, I've touched on it a little bit, but, just to finish off the last couple of slides, we're looking at entry criteria. There are various ways, but tonight I'm just going to focus on the standard entry for you, keep it as simple as possible. So, depending upon the time frame that you are looking to. So, in this particular case, this is a pullback. We have an inside bar. So, you're looking to enter on the break of the high for a long trade, or a break of or the low for a short trade. And you would normally have, between 2 and 10 pips. So, what we're looking at, 10 pips I would be using there on the weekly, okay, and 2 is probably what you'd be looking at on time frames beneath that. So, in this particular case, with prices pulled back, we have an inside bar, so we're expecting price to break out of it there, right, which it does, and our stop is the other side of the bar. For those of you who like a target, well, realistically, we're still looking ideally for at least a minimum of 1-to-1, okay, preferably 2-to-1 and above. For those of you who like to trail, some of you might be saying that looking at like a two-bar trailing stop is a very, very simple, almost mechanical way, and that can be a very simple way to actually to achieve that and to get on board that particular trade. So let's just get rid of that. So what we have there is inside bar is a very simple price action setup. It's set up on all time frames, okay, on all instruments, and you can trade it as either during a pullback in a trend or a breakout into a new trend. All right. And that's the important thing. It's set up on all time frames and on all instruments. Okay, so regardless of what you're trading yourself, you'll find a place where you can actually look and see and find that that opportunity. And you're either looking to trade it as part of a pullback in a trend or as a breakout into a new trend. So there you go, ladies and gentlemen. There we have, with a couple of minutes to spare. I hope you found that useful. I hope that's given you some insight into what an inside bar is, how it qualifies as one. B, the couple of ways that you can actually trade it, and see a few examples of how you can see those trades in terms of pullbacks in trends and also as parts of breakouts into new trends. So, my suggestion is, my challenge is, go away for the next month, go through your Valutrades, MetaTrader 4 charts, and just look and try and identify where are the inside bars, were they part of a breakout, or was it part of a pullback in a trend, and see how they worked out, and if it's something that you can add to your own trading armory. As always, I wish you the best of luck with your own trading. If you've got any last 1 or 2 questions, then I'll be happy to answer any questions. That's very kind of you, Anne. Thank you very much. Nice of you to join us, and nice of you to join us there. I hope you're all well. But as always, for the rest of you, I wish you the best of success in your own trading, and I look forward to seeing you at the in the Valutrades series of webinars. It's George. George using women's names, not for the first time, from what I've heard. George, thank you for that, and thank you, Tony. That's I appreciate the feedback. That's very kind of you. I hope you found that useful, and yeah, good luck with your own trading. You're very welcome, Robert. Thank you. Thanks for joining us. I apologise for that little couple of minutes. There was a minute or two there where we had a little bit of a internet dropout, but hopefully I recovered that and went over that, and hopefully found that we're all useful. And if you've got any questions, by all means, the Valutrades team are here to help, and they'll be happy to work with you. So please fire away at them. Ask them everything that you may wish.